Video will describe the overview of the three financial statements. Now, many of you are very familiar with the financial statements and the calculations behind them, but some of you may not be as familiar, and I thought I'd give an introduction to the three financial statements as we will be using these in the ETA class. All right, here are the three financial statements: the balance sheet, income statement, and cash flow statement. Let's start with the balance sheet. This is at a specific point in time, typically at the end of 1 month or at the end of a year. Broken into three sections: assets, liabilities, and shareholders' equity. In the assets section, it's split between current assets and long-term assets. Aside from cash, major current assets are accounts receivable, the money that is owed to you by your customers for products you sold them, inventory that's sitting on your shelf or in the warehouse. Long-term assets are assets that will last greater than 1 year, and it's the purchase price that you purchase those assets for, less the permitted accumulated depreciation that the IRS and generally accepted accounting principles permits you to deplete them over time, and you get net fixed assets. Goodwill, which we'll cover later on in the course, and that gets you to your total assets. Liabilities are similarly broken into current liabilities and long-term liabilities. Accounts payable and short-term debt are the typical short-term liabilities that you have, and these are liabilities that you need to pay within 1 year. So the AP is money that is owed to you by your vendors. Long-term liabilities are liabilities that are owed to you for more than 1 year, greater than 1 year. So it's long-term debt and some other long-term liabilities. And then you finally have shareholders' equity, which is preferred stock. We'll talk about this later in the class. Common stock and the capital that you actually put into the company when you form the entity. And then the last item in shareholders' equity is retained earnings. These are the accumulated earnings that you've generated over the life of the company. And that gets you to total assets and total liabilities and shareholders' equity. Both of those must equal each other, and that is the reason why you have the word balance sheet. Assets must balance to liabilities and shareholders' equity. Again, this is at a specific point in time, and a summary is what you own and what others owe you. So the next statement is the income statement, which is over a period of time. So for instance, 1 month, 1 quarter, or 1 year. Very simply, it is revenue minus the cost of goods sold, which is material and labor typically, minus depreciation of your fixed asset, which, as you recall, came from the balance sheet. That'll get you to gross profit. And then operating expenses like office labor, management, perhaps a building. Interest expense is the amount of money that you pay each year for the interest that you paid to your lenders. That'll get you to pre-tax income, income tax, and then your net income. So that's a very high-level summary of an income statement for GAAP purposes. But the most prominent and popular terminology that you'll see in the M&A world, and that we'll talk about in the class, is EBITDA, which is derived from the income statement. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And you get that by using the net income from your income statement, plus interest expense, plus taxes, plus depreciation will get you to EBITDA. So that's the summary. EBITDA is not part of a GAAP income statement, but is always used as a proxy in the deal world for cash flow. So again, the income statement is your profitability, and this is calculated over a period of time. Finally is the cash flow statement. This is also over a period of time, broken into 3 activities: operating activities, investing activities, and financing activities. In the operating activities, you take your net income, which comes from your income statement, and you add changes in working capital, and working capital is your current assets minus your current liabilities on your balance sheet. That'll get you cash flow from operations. Investing activities is your capital expenditure you paid during that period of time, perhaps a year. And then if you disposed of any assets, the proceeds that you received from the disposal of those assets. And that'll get cash flow from financing. And then the last bucket is new borrowings that you incurred, minus any borrowings you repaid, and minus any dividends that you paid to your shareholders. And that'll get you cash flow from financing activities. Added together, this will get you your total cash flow over that period. Two notes at the end of a cash flow statement are typically the cash at the beginning, cash, which is the cash balance, not cash flow, and then cash at the end of the period. So that cash on your balance sheet here at the end of this period will tie to this note at the end of your cash flow statement. So again, the cash flow is the movement of cash throughout your company and then is measured over a period of time. And that's a summary of the financial statements overview.